Bonds are a type of debt security that are issued by governments, corporations, and other entities to raise capital. They are a form of loan that the issuer promises to pay back with interest over a set period of time. Bonds are an important part of the global financial system, providing investors with a safe and reliable way to earn a return on their investments. In this essay, we will explore the different types of bonds, how they are priced, and the risks associated with investing in them. Bonds are a type of debt instrument used by governments, corporations, and other entities to raise capital. There are several different types of bonds, each with its own specific characteristics and associated risks. The most common types of bonds include municipal bonds, corporate bonds, treasury bonds, and government agency bonds. Municipal bonds are issued by local governments to finance infrastructure projects, such as schools and roads. Corporate bonds are issued by companies to raise capital for business operations. Treasury bonds are issued by the federal government and are backed by the full faith and credit of the United States. Government agency bonds are issued by government-sponsored entities, such as the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. All of these bonds involve an agreement between the issuer and the investor wherein the issuer promises to make regular payments to the investor in exchange for a loan. Zero-coupon bonds are bonds that do not pay interest until they mature. Convertible bonds are bonds that can be converted into stocks at a predetermined price. Bond pricing is an important consideration when investing in bonds. Bond prices are determined by a variety of factors, including the issuer's creditworthiness, the bond's coupon rate, and the current market interest rate. For example, a bond with a higher coupon rate will typically have a higher price, as the bond offers a higher yield. On the other hand, a bond with a lower coupon rate may have a lower price, as the bond offers a lower yield. Additionally, the current market interest rate can have a significant effect on the bond's price. If the market rate is higher than the coupon rate, the bond's price will be lower than its face value. Conversely, if the market rate is lower than the coupon rate, the bond's price will be higher than its face value. Understanding these factors can help investors make informed decisions when investing in bonds. Investing in bonds carries certain risks, including the potential for losses if the bond issuer defaults on their payments. Additionally, the value of bonds can fluctuate over time, meaning that the value of the bond may be lower when you go to sell it than when you purchased it. If interest rates rise, the value of existing bonds may decrease, as investors may be willing to accept lower returns for new bonds. Finally, there is a risk of inflation eroding the value of the bond's payments over time. It is important to understand the risks associated with investing in bonds before making an investment. Investing in bonds can be a smart way to diversify your portfolio and reduce risk. Bonds are a type of debt security that pays a fixed rate of interest until maturity. When you purchase a bond, you are essentially lending money to the issuer, who is responsible for repaying the principal plus interest at a specified date. Bond investments offer a variety of benefits, including income, diversification, and capital preservation. Bond income is generally higher than other income sources, such as savings accounts and certificates of deposit, and is usually reliable and predictable. By investing in bonds, you can also diversify your portfolio, as bonds are less volatile than stocks. Additionally, bonds can help protect your capital from market downturns and provide a cushion against inflation. Investing in bonds can be a great way to diversify your portfolio and add stability to your investments. However, there are tax implications associated with investing in bonds that you should be aware of. When you purchase a bond, you are essentially lending money to the bond issuer. The issuer then pays you interest on the loan. This interest is taxable income, and you will need to report it on your tax return. You may also be subject to capital gains taxes if you sell the bond for more than you paid for it. It's important to understand the tax implications of investing in bonds before you make any investment decisions. In conclusion, bonds are an important part of the global financial system and can provide investors with a safe and reliable way to earn a return on their investments. There are many different types of bonds available, each with its own set of characteristics and risks. Bond prices are determined by a variety of factors, including the issuer's creditworthiness, the bond's maturity date, and the current interest rate environment. Investing in bonds carries certain risks, but it also offers many benefits, including a steady stream of income and diversification benefits. It is important for investors to understand the tax implications of investing in bonds before making any investments. Thanks for watching, and don't forget to subscribe so I can make more videos like this.